Hello there. I know it's been a while. November and December turned out to be crazy months. I haven't been able to do much. But I have seen several videos from other content creators talking about what their investment strategy is for 2021. And I thought I'd join in that. If you have any questions about the points I make in this video, please feel free to ask on YouTube, on my Facebook page, or in chat if you have contact. I am not a financial advisor. This is simply my journey and I'm sharing the steps that I take. I divide my portfolio into 3 segments. I have my 401k through my employer, I have my investment accounts at ETrade, and I have my cryptocurrency accounts on Coinbase and a few other wallet systems. Let's talk about my 401k first. My 401k through my employer is something that I started as soon as I was eligible, and I've contributed at least up to the employer match since the beginning. The current balance is $316,806.35. I currently have my investments in my 401k broken down as follows. Target Date Retirement Fund at 50%, the Voya Large Cap Growth Equity Fund at 20%, the William Blair Small to Mid Cap Growth Fund at 20%, and the Neuberger Berman Genesis Fund at 10%. This automatically rebalances every 3 months, and I don't plan to change it. This is the foundation for my long-term future, and when I roll it over into a Roth at 65 or whenever I retire, I'll be able to get the stocks and funds that I want with whatever that balance is. I'm putting in what I need to get the employer match, which is a 100% return immediately. That's good enough for me. Here's my rate of return graph for the last 12 months. Not bad. Now let's talk about ETrade. Here's a snapshot of my accounts today, January 17th. I have 3 accounts on ETrade. My taxable account is the account that was created when my Capital One investing account was transferred over in November of 2018. This is the original investment account that I started on ShareBuilder in June of 2000. I had used this account for my dartboard strategy from 2000 to 2010 and for my high yield strategy from 2010 through 2019. This is also the account that I transferred my Robinhood account into back in April of 2020. I have the full transaction record for everything I've done with this account, and going over that history is a fun project, sometimes, not today. My other taxable account is the original account that I opened at ETrade back in 2009. The fees at the time kept me from using it very much, but it was a good account to receive my shares of Enviromission when the broker that I had bought them from was absorbed into Wells Fargo. Enviromission had since been delisted off the Australian Stock Exchange, and I don't know if they will ever be back, but there's no point in spending the money to sell the shares, so I just leave them alone. This account is also a good place for me to keep stocks that don't fit into my TGI strategy, like AT&T, Square, Beyond Meat, Virgin Galactic, and the Procure Space ETF Trust. I also have a penny stock, Metatron, MRNJ, that I bought on a whim at one point in early 2018, going for broke on the high-risk strategy. I bought 869,565 shares for around $100. If that ever gets to $1 per share, drinks are on me. My Roth IRA is something that I started in October of 2010. But while I knew everything there was tax-free, I was just getting started with the high dividend yield strategy and thought for several years that I would be generating a large enough revenue stream that I could retire early, and I didn't want that money trapped by tax shelters. I was a darn fool, and I missed out on so much growth and revenue because of that. Oh well, lessons learned. I used my main taxable account for my current strategy of total growth at the beginning of the transition away from high yield. before I realized the opportunity cost of not using my Roth IRA. Right now, it holds high-ranked TGI stocks exclusively. And if my Roth contributions for 2021 exceed the contribution max of $7,000, this is where my additional capital will go. And by the way, I did not exceed that limit for 2020. I missed it by $1,776.79 because of everything that was going on. But I'm not too worried about it. I do want to try to make that up over the next several months. I use my ranking list to determine whether or not a dividend is subject to DRIP or not, dividend reinvestment. If a stock is within the top 100 stocks on my list, DRIP is turned on, and I will let that compound. And this applies over all of my accounts. Now, let's get to the transparency part of things. I have never revealed my entire portfolio before, so this will be interesting. Here is my main taxable account. What matters to me is the long-term total gain percent number. And you can see I only have one that is negative, and that's Reynolds, the company behind Reynolds Wrap. They had an IPO early in 2020, and I grabbed one share because why not? They don't have a history to rank very high, so I'm not compounding their dividend, but the important thing is they're paying one, which is pretty cool. The rest of their major gainers at the top are the ones that I'm really proud to own. Tesla, hello. Here is my miscellaneous account. The Q stock down at the bottom is Enviromission. If they ever get relisted on the ASX, great. If not, whatever. And finally, this is my Roth IRA. Sorry about the font size, it is a longer list. There's no spectacular gains on this one, just steady growth and compounding. So, how has this portfolio set done over the last year? First, let's look at my taxable account over the last 2 years. I started my transition away from high yield and into total growth in November of 2019, and I went full bore into it right when the COVID crash happened. The gains since that point have been substantial, and I credit the TGI strategy for that. Here's my miscellaneous account. That's not as impressive. That spike in late December was all Metatron, when they spiked up thanks to a decision by their board of directors to actually become compliant with the SEC. Don't ask. The main stock that earns a dividend in this account is AT&T. It's the second stock that I bought back in 2000, and I have no plans to sell it out of here since it adds over a share every quarter thanks to DRIP. I sold AT&T out of my Roth to focus that capital into more high-growth stocks, but this account, I'm fine keeping it for the revenue and compounding. Here is my Roth performance over the last year. Whether the return beats the S&P really depends on the timeline, but I'll be interested in watching to see how it goes this year. Now, what are my plans for how to grow this during 2021? I have a stock strategy. I'm sticking to my total growth investment ranked watch list and following my diversity plan. But I'm basing that diversity plan by looking at my overall portfolio, not just stocks. But I'm not talking about my 401k because those are already fully diversified funds. So what's left? Cryptocurrency. I have been struggling to decide how to talk about cryptocurrency on this channel. It is part of my portfolio, and I've revealed that. But one of the groups that I'm part of, the main Dividend Growth Investing group on Facebook, strictly forbids discussion of this financial sector. For good reason. Nearly every single random chat out of nowhere that I get is someone trying to get me into this or that revenue scheme. I'll tell you right now, I'm not interested. Don't bother. Not that they will listen. I was introduced to Bitcoin in May of 2017, and I recognized what it was immediately. Bitcoin is a global reserve asset. It is literally the hardest money ever created. The mining of the blocks generates new coins on a set schedule that we can see in the code. if you can read the code. When the blockchain was first launched, that reward was 50 Bitcoin per block mined, and that lasted for 210,000 blocks. Then the block reward was divided in half to 25 Bitcoin per block. In May of 2016, it divided in half again, reducing the reward to 12.5 Bitcoin per block. And on May 11th of 2020, the reward was divided in half again, reducing down to 6.25 Bitcoin per block. This will continue every 210,000 blocks until the final reward is paid out in the year 2140. The expansion of the supply of a currency is the very definition of inflation, and we know exactly what the inflation rate will be for Bitcoin for the next 120 years, at which point that inflation will become zero. No other asset or resource has ever been created with this sort of controlled supply curve, and the total amount of Bitcoin that will exist when that final reward is generated will be 21 million. No more, no less. Right now, there are many, many more millionaires by today's standards in the world than there will ever be Bitcoin in existence. That's what I recognized in 2017. I did get caught by the get-rich-quick mentality, like so many people did in 2017 during that massive bull run. I didn't think that the transition over to Bitcoin as the global reserve asset would happen overnight, but I did get a little caught up by the fear of missing out. I had been into my high dividend strategy in the stock market for 7 or 8 years, so I was looking at ways to generate Bitcoin fast. And well, we made some bad decisions, and that cost us a lot. Lessons learned, and the calendar only moves in one direction. So here's a chart of my portfolio balance on Coinbase since I opened my account in May of 2017. 2020 has been an amazing year for Bitcoin and cryptocurrencies in general. Narrowing that chart down to just the past year shows that pretty clearly. Now, the value of Bitcoin changes minute by minute, thus the slight difference between these two graphs that were generated just a few minutes apart. Here is a snapshot of the top 6 coins that I have on Coinbase, not including the US dollar. The rest of them are ones that I've earned through their video classes, and they're not really worth mentioning. Not to say they're worthless, they're just not my focus going forward. This is why. These blockchains pay a reward back to coin or token holders, and Coinbase collects the fees for the blockchains that they offer to their customers and distributes them based on coin or token ownership. I'm not planning to pull any of the value out of my cryptocurrency wallets, and while I will drop 50 or even 100 when I have a lot of extra money, I don't plan on making any large purchases. And I'm depending on these rewards to generate the revenue stream for my cryptocurrency accounts going forward. During 2021, I'm planning to focus on Algorand, which is earning 6% annually. That might not sound like much, but the trick is that Algorand and DAI are both compounding daily, while Tezos is compounding every 3 days. I also do have some other tokens in other wallets, all focused on Ethereum tokens. I've also made some $100 investments into a few things, and during 2020 I got a few airdrops, including the Uniswap airdrop back in September, after using their service in June to buy some tokens with Ethereum. I'm not going all in on anything. I'm just testing the waters, and if something seems too hot, I'll pull my hand back. So, how does all this fit together? What is my investment strategy for 2021, both stocks and crypto? In terms of new capital, I'm putting in $100 every 2 weeks into ETrade, and I'm putting in $25 per week into Coinbase, about half. I've already mentioned my plan for Coinbase, focusing on Algorand until I can build up a good revenue stream with the staking rewards. Those rewards will help me reach my goal of getting Bitcoin up to 1.0. Just because. Why not? Then I'm planning to focus the compounding towards building up my Ethereum balance, because the movement of that blockchain towards their 2.0 proof-of-stake infrastructure over the next few years I see as a complete game changer for the entire financial world. We'll just have to see. But let's get back to stocks. My plan for ETrade is to follow my diversity rules and my total growth investing ranked watch list. Let's look at my current diversity on ETrade. That top red sliver is utilities at 1.1%. So here's my top 12 stocks on the TGI rank watch list right now, so I can talk about my strategy going forward. First, remember that these ranking scores change frequently, sometimes daily. Based on today's rankings on the TGI list, the next stock that I need to be buying is Sherwin-Williams. It's in the materials sector, which is at 9.48, giving me a little bit of room. I don't have any right now, so it's completely open. But the stock value is at $725.55, an amount that would take at least 4 months to accumulate at $200 per month, like I've discussed. I could do that, but I rarely like to wait that long between buys. Eventually, given that Sherwin-Williams is at number 6 on the ranking list, I will probably want to buy one share. But that's a long time to wait. So my other option is to look at my overall portfolio, combining ETrade and cryptocurrencies into the same chart. The way I do that is by declaring that crypto is a sector for the purposes of diversification, much like I consider diversified to be a sector when I'm talking about broad-range exchange-traded funds, like SPY-G or VOO. If we do that, the diversity pie chart looks a little different. Now, blame Bitcoin for going from 3,400 to 40,000 in a single year for that. But it does push the other sectors, like information technology, down to 7.8%, giving me an option to buy less expensive stocks. Granted, Global Payments at number 1 is still at 191.38, but that's still less than 725.55. So, that's my strategy for 2021, and I hope you enjoyed the transparency. It has been a few months since I put together a video, and I guess this microphone will work. I just had to get used to it. Feel free to comment on the video, and you're welcome to call me crazy for having so much of my portfolio in cryptocurrencies or for having so much in the old-fashioned stock market. I'm looking forward to seeing how things might change over the next decade. The disruption has barely begun. But at the same time, companies will still be doing business, producing products and services, making a profit, and paying dividends. I want to capture both sides of this. Whether a company continues to pay in US dollars or some kind of stablecoin or whatever, that's just a change of infrastructure and platform, and we need to be ready for whatever comes. Please like the Facebook page and subscribe to the YouTube channel. I'm working on my next stock review, reading the annual reports for Teradyne. And I'm continuing to moderate the groups, both dividend growth focused and cryptocurrency focused. I'll talk to you there.